The auto parts industry has given us some incredible historical growth. As you can see, O'Reilly Automotive here has been a very consistent grower. Earnings have increased year after year after year at an average of over 19.36%. From a performance point of view, that turned $10,000 into $502,000, going back to January 4th, 2002, generating a 20.4% annualized rate of return versus the S&P 500 that only did 7%. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And I'm going to do a video here on advanced auto parts. And I, started this video looking at O'Reilly Automotive, the fastest growing of the three major auto parts manufacturers. And the auto parts industry has primarily been thought of as a growth stock industry. A couple of things, if you'll notice as I get into the fast graphs, that, these companies have been really fast growers and really strong growers and really consistent growers. And the one oddball in the group is advanced auto parts, which I was actually asked to cover. And I'm going to look at that because what we're looking at is a difference between picking an investment at the right time. Timing is ultimately everything, but it's not market timing. It's timing the right time to make an investment decision on a stock. That's really what's key. So let's go ahead and get into the fast graphs, and let's go back to O'Reilly Automotive. When I put weekly closing stock prices on this graph, you can see that stock prices have tracked earnings beautifully. Now, we're doing this at the P equals growth rate of 19.36%. Okay, so in other words, we're putting a very high valuation. So we're saying that normally, this is a 19 times earnings company, but it's currently trading at over 24 times earnings. What I'm suggesting to you is that although this stock has traded tremendous performance, and if you notice when I did performance, the average rate of return was 20.4% with no dividends, which is higher than let's say a little over 1% higher than the average growth rate. That's because of the high valuation of the stock. But I want you to notice some things here. The stock is now trading at a very high valuation. If I drop this to a 15-year graph, you can see that the stock is overvalued. It has over 115% debt to capital, which I consider negative. It's a BBB rated company, and even though it's had this tremendous growth record, I consider the stock very expensive. I also want you to notice there's no dividend line on this graph. The stock doesn't pay a dividend. It has a massive amount of debt in a rising interest rate environment, and the stock is overpriced. Now, if we go to AutoZone, a very similar story, we get a 17% growth rate. Here we're valuing the stock with a PE ratio of 17. But if I put stock price on the graph, you see, that once again, almost the identical picture. You see the price follows earnings. You see it getting undervalued, and you see it getting overvalued. But because it's grown so much, you really couldn't even have historically paid too much for this company in the past. But once again, we have 163% debt to capital, no dividend, and the stock looks overvalued today. Again, we can shorten the time frame here, and we see the same picture we saw with O'Reilly. From a performance point of view, if I'm looking at performance, it is dramatically outproduced the market. If I go longer term, it's dramatically outperformed the market. But again, the performance is 18.68%. And if you look at that from a standpoint of a 17% growth rate, it's because the stock is overvalued. But now let's look at the we'll call it the stepchild in the auto parts industry. The other two stocks, before I leave them, they have very large market caps, $46 billion for AutoZone. If we look at O'Reilly, O'Reilly has a $50 billion market cap. So both of these are much larger companies than AutoZone, which has about an 8.97%. Now, AutoZone is not really a poor performing stock. It's averaged over 13.66%. which has given it a PE ratio, a fair value PE ratio of 15. And you can see there, times when you could buy it. And what's interesting about AutoZone, I want you to notice that they've always they've paid a dividend since 2006, but they had a very low dividend payout ratio of only about 10 or 11%. But they paid that dividend steadily. It was a steady 24% dividend up through 2020, when then they raised it to $1. And the payout ratio was a little higher, was getting higher. And then they raised it to $3. Then they've recently raised it to $6, and this has been a very strong increase. The company is now becoming a dividend growth stock. It's always been a moderate dividend payer. Compared to its, competitors, it has about a 50% debt to capital ratio. It's offering a 3.99% yield today. It says 3.96 on this graph, which was through yesterday's close. It's currently offering about a 3.99% yield. We can quickly go into Google Finance here, and we can see that it's actually over 4% now. The stock is down about 1% today. So it's offering over a 4% dividend yield if you bought it at this very moment that I'm doing this. Now, here's what's interesting about this, what I want you to understand. With investing, especially as a value investor, there's different ways to make money in the stock market. Investing in Advanced Auto Parts is really all about investing in a dividend stock at a very low valuation. I want you to notice the earnings yield now is 8.34%. The company has moderate level of debt. And if I'm looking at this stock from a standpoint of coverage of the dividend, it has very strong coverage of the dividend with operating cash flow, and free cash flow barely covered the dividend last year, but it's expected to grow again. So it's got good dividend coverage. The company has announced a buyback, a share repurchase program, which I like very much considering that it's undervalued, and they've increased their dividend dramatically. So if you're buying this stock today, you're looking at an opportunity for over the next 2 or 3 years of averaging over 20% a year with a 4% dividend yield that's expected to grow. Now, looking at it from a performance point of view, historically, it hasn't been a stellar performer like the others, but Advanced Auto Parts has outperformed the S&P 500 on a capital appreciation basis, long term. It's also produced about the same level of dividend income, but that's when it was only paying a very low, amount of income and not increasing the dividend. In recent years, notice that the dividend has increased dramatically. In fact, if I shorten this time frame to like the last 4 years or maybe last 5 years, you see that dividend growth has been, extraordinary and, of course, unsustainable. But the point is, the company is morphing from a moderately fast growth stock to a dividend growth stock. It's extremely undervalued. And I want to talk about this a little bit. This 15 PE ratio, I think one thing that a lot of you don't understand or don't consider at least, is this would represent an earnings yield of 6.5%. We now have an earnings yield of 8.34%. So that means that we've got a below fair value stock. And, the market normally has priced this stock at a 17 PE ratio, as you can see long term. Over the last 15 years, that's changed to about an 18 PE normally. So we now have it undervalued. It's got a nice margin of safety built in. They've increased their dividend dramatically, and the stock is cheap. So if you were going to invest in the auto parts industry today, I believe Advanced Auto Parts is your choice. So why would I say that? Why would I choose Advanced Auto Parts over the other two? Well, I've already covered it, but I do want to repeat myself because I think it's very important. Now, this is obviously the slowest growing of all the auto parts manufacturers, 13.6% versus over 17% for AutoZone versus 19.3% for O'Reilly. So clearly the others have the best growth rates. But as I pointed out, the others also have very high levels of debt in a rising interest rate environment that is really, very problematic, because this company, I think, has very manageable and very controllable debt. But the real issue, the crux as Mr. Valuation, is with all the negatives I just pointed out, the fact that this stock is carrying a whole bunch of debt, regardless of how fast it's grown, is trading at a very high valuation, O'Reilly is, and so is AutoZone. Yet I can look at Advanced Auto Parts and I can get it at a very attractive valuation. So let's look at what potential would be, assuming the consensus estimates are correct here. If I look at it over the next 3 years, I can make 22% a year. Over the next 2 years, I can average 21% a year, plus get dividend income yielding 4% right now currently, as I just pointed out a little while ago. So we've got a 9% potential grower that I can buy at a very attractive valuation with a nice margin of safety, moderate growth going forward, and I get a dividend and I get good valuation. In contrast, if I go to AutoZone, for example, and look at forecasting, I've got a 10% grower, only 1% potential more, because AutoZone, has been a fast grower, but Advanced Auto Parts is actually making headways on that, and it's a much smaller company, as I pointed out. I would actually be looking at over the next 2 years a negative rate of return if this reverted to the mean and went to a 15 PE. Now, if it traded at its normal multiple of about 16 over the next 2 years, I would have a rate of return that would still be negative, but really not that bad. And keep in mind, I have no dividend. And the odds are a stock with this much debt, and, even though it's been a fast grower, it really doesn't give the opportunity to give me any income or give me any safety because of its valuation. And O'Reilly Automotive is really the same, expected to grow at the same rate or approximately the same rate as Advanced Auto Parts. I get no dividend, and I get a very high valuation that over the next 2 years could lead to double-digit losses if it reverted to the mean. And even if it traded at its very high multiple, I'd still only get a 6 or 7% rate of return, and that would all be predicated on capital appreciation or stock increase because I get no dividend. I start out in Advanced Auto Parts with a 4% dividend. So I've got 2/3 of the return that I could get there already built in just on the income alone. And I've got a low valuation. I've got a chance for it to revert to the mean. And that puts me in a very good position as an investor. So maybe 10 years ago, I'd rather had AutoZone or O'Reilly Automotive over Advanced Auto Parts because they were growing faster and they were actually reasonably priced, most of the historical time frame that I showed you here. I could have bought it at a reasonable price and generated very strong rates of return. I'm going to measure it to value, not to where it's overvalued now. O'Reilly would have given me a 22% rate of return over this time frame. That's starting out on January 14th, 2011. If I'd have went into Advanced Auto Parts, January 4th, 2011. Let's see if we can find it here real quick. That's close enough. And go out here to fair value again, only to fair value. I'd have made half the rate of return, 10%, but I would have got some dividend income. So the key is you also have to look at what your goals and objectives are. Advanced Auto Parts has been the weakest performer from a historical basis, but because of its valuation opportunity right now and because of its high dividend yield, it offers in a rising interest rate environment, I think, a level of safety because of the margin of safety. It offers some good growth potential, about the same as the other two companies at this point, but at a much, much better valuation. So that's why I would choose Advanced Auto Parts and why I generally choose dividend stocks over growth stocks, because at least with a dividend stock, if I do run into trouble, I get the income. And let's visit that a little bit. Let's look at a recent stock that I talked about. I'm going to offer a little bonus here outside of the auto parts industry because we had Skyworks Solution just generate a 12% price appreciation yesterday. And the stock was, very, very strong, obviously, on a very good earnings report. Now, a lot of people would say, it's over, but I do want you to point out that I did a video on this a while ago. I did a video on Skyworks Solution about a year ago. And, I talked about it was actually November 5th, 2021, and the price was 164. So that's about, what I've got marked here. It was even a little higher because we weren't expecting these down earnings at that point. But the point is the stock has collapsed and fallen dramatically. Now, I believe if you own Skyworks for 2 or 3 years, even on those prices, you'd have made money. But there wasn't a margin of safety. In the video, I did point out that I would have liked to seen it cheaper. I was just pointing out that the stock had really come into fair value. Well, here we are now, the stock would be down about 19%. But if I look at what the stock did in the last couple of days, if I look at it from a standpoint of just, maybe go the closest I can go here, February 3rd to yesterday, that's a 9.3% return. That's about what it went up. It went up a little bit more. It went up 12%, so I could go a little more. I want you to notice when you look at it on a fast graph like this, it's really not, that dramatic. It has gone up. In fact, the stock's recovery from its very bottom has been exceptional. The better valuation you buy it at, the better rate of return you're going to make long term, assuming the fundamentals are still higher than what the valuation is. We did have a break in fundamentals here, but we also had a major overreaction by the market. I want that to be very clear. fundamentals, even with the negative earnings, they're theoretically going to generate this fiscal year. Remember, they have a September fiscal year. And so, we're going into the second quarter. Now, if you look at what happened to Skyworks, if you look at going to Seeking Alpha here, and you can look at what happened, why the stock was up so much, it was because they had a very good earnings report. And, they also gave a nod for a $2 billion stock buyback program. I like that when the stock is cheap. So the market reacted strongly. And the point I want to make and close on this is that when you're buying value, inevitable reversion to the mean can happen. There's a strategy out there, and I'm going to be talking about this more in the future. It's called the acquirer's multiple, where what you try to do is buy distressed companies at very, very low valuations based on their total enterprise value, which includes debt and cash. I'm going to be talking about this in the future, but the point is Skyworks got very, very inexpensive, and that's why it was vulnerable to a high multiple. And I want to emphasize that when stocks are very undervalued, the volatility can be very quick. Skyworks was up 12% plus yesterday. Likewise, when stocks are overvalued, going back to the companies like ORLY and AutoZone, when stocks are overvalued, the price can drop very, very dramatically and very, very suddenly in a very short period of time. So valuation matters, and it matters a lot. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I wanted to give you a look at, a very good dividend growth stock right now. I think a company that used to be more of a low-yielding, moderately growing company has now turned into what I'll call an above-average yielding dividend growth stock with a lot of growth potential, and it still has a reasonable payout ratio. So what I would suggest is you might want to start taking a closer look at Advanced Auto Parts right now, because it does look very attractive. It does offer a good dividend yield. And relative to the other stocks in its industry, it has good debt. And the company is really doing a lot of things to position itself for the future. You can go on Morningstar and other sites like that and really read about what this company's doing. So, if I was going to buy an auto parts company today, it'd be Advanced Auto Parts. Anyway, thanks for watching. If you enjoyed the video, give me a like, subscribe to the channel, and take a look at FastGraphs. It really can help you make sound decisions and good long-term investment decisions, probably as well as any I've ever seen. Thanks for watching.